Welcome back to the Explainer Traders. We've got a seriously action-packed session today, defined by some incredibly heavy macro cross-currents and absolutely critical technical triggers. We're looking at shifting geopolitical sands, massive, and I mean massive capital deployments, and a whole slew of economic data releases, all just crashing together at exactly the same time. If you're navigating these markets right now, you need to know exactly what happened overnight, and you need the hard technical setups for the major currencies and Indian equities heading into today's session. So buckle up, because we're going to unpack the whole shebang right now.
Okay, let's just dive right into it. We really have to anchor our entire view of today's risk environment on this one thing: oil's relentless climb toward $98 a barrel. This isn't just some random number flashing on your terminal. It's the literal physical manifestation of global geopolitical anxiety. US-Iran diplomacy has essentially hit a wall, and because of that, the geopolitical risk premium in the Middle East is just running red hot. Basically, every trader out there is checking oil prices every 5 minutes, because as long as the threat of disruption hangs over the Strait of Hormuz, that $98 level is acting like a massive economic gravity well.
Now, peeling back the layers on that geopolitical tension, we're seeing a pretty stark difference between the flashy headlines and the actual reality. So despite President Trump announcing a halt in hostilities between Israel and Hezbollah, the situation on the ground is way less settled. Israeli officials have actually come out and clarified that operations in southern Lebanon are continuing, and cross-border fire is still happening. Over on the US-Iran front, Secretary of State Marco Rubio made it crystal clear that just reopening Hormuz isn't going to magically erase sanctions. Tehran has to actually make concessions on its nuclear program. And just to add a little more pressure, the US just sanctioned Iran's largest crypto exchange. So what's the takeaway here? Durable peace moves at the speed of Middle East negotiations, which means we're measuring progress in months, definitely not in daily news cycles.
And honestly, this dynamic brilliantly illustrates the insane push and pull traders are facing right now. In one corner, you've got this absolute AI fever. Global equities are just surging on incredible tech optimism. Anthropic just filed a confidential IPO, and Alphabet is reportedly raising a staggering $80 billion with a B just for AI infrastructure. The capital flowing into this space is literally off the charts. But in the other corner, we've got a very stark reality check: oil anxiety. If those Middle East tensions we just talked about lead to prolonged disruptions, the inflation fears that follow could severely threaten this entire tech-led rally. It's just a massive macro tug-of-war.
Moving into Section 1, today's economic watch list.
So get ready for what we're calling the PMI parade. Today's timeline is completely stacked. First up, we're getting fresh clues on economic momentum from the Eurozone and UK services and composite PMIs. Then, everybody's attention is going to snap straight to the US for the ADP employment report, the ISM services PMI, and factory orders. Finally, we cap the whole thing off with crude inventory data and some really crucial remarks from Fed Vice Chair Barr and ECB official Elderson. With all these growth indicators, labor updates, and oil numbers clustering within just hours of each other, you're going to need less caffeine and a lot more seatbelts today for sure.
Let's pivot to Section 2, Indian Markets Overview.
Look at that pop, over a 4% rally in IT stocks. This was absolutely the hero of the previous trading day. Easing crude prices basically gave the market a window, and heavyweights like Infosys and Wipro totally led the charge. It just goes to show that when the broader market desperately needs a lift, the IT sector still knows exactly where the power button is. This massive IT surge single-handedly snapped the Nifty 50's painful 4-day losing streak, lifting the overall index by about 0.43%. So breaking down the actual flows a bit more, the Nifty managed to close at 23,483.55. We are also seeing some genuine, real optimism in the bond markets ahead of the upcoming RBI policy meeting. The 10-year yield eased down nicely to exactly 7.0%, and the 1-year overnight index swap closed at 6.11%. But hold on, we do have to inject a quick note of caution here. The rupee actually weakened to 0.3% to 95.2650 against the dollar. Why? Persistent selling from foreign institutional investors. So while the index managed to bounce, those ongoing FII outflows, combined with the Middle East tensions we covered earlier, are keeping the overall mood pretty cautious right now, rather than outright cheerful.
All right, on to Section 3, Global Currency Technical Levels.
Now, what's really interesting here is the yield curve structure supporting the US dollar index. The 2's10 spread is sitting at positive 42 basis points. Basically, that modestly upward-sloping curve is telling us the market expects a near-term hold on rates and a cautious but steady growth outlook. Backing this up, the ISM manufacturing PMI just printed a super solid 54.0 in May. That's the highest we've seen since May 2022.
Add in today's upcoming S&P Services PMI and the ADP jobs data, and the fundamental floor for the dollar is looking quite firm.
So tactically, for the DXY, we're looking at a mild buy on dips. You want to look for support to hold around those 99.00 and 98.79 levels. If we do get a push higher based on today's data parade, your hard resistance sitting right overhead is at 99.64.
Over to the euro, well, it's kind of tricky right now. The ECB rate hike coming up on June 11th is largely already priced into the market. That means any real upside for the euro is completely dependent on either a surprisingly hawkish economic projection from them or a sudden de-escalation in Iran that happens to soften the US dollar. Interestingly enough, the escalating tensions over on the Ukraine front are currently being entirely ignored by currency markets. They're just completely overshadowed by the Middle East right now. Keep a very close eye on the HCOB Services PMI prints dropping today across the Eurozone.
Because we're currently missing that upside spark, the tactical structure for EURUSD is a sell on rise, though obviously proceed with caution given the massive PMI data dump today. Your strict resistance level is at 1.1656, and if the sellers take the wheel, you're looking for support down around 1.1612.
What about the British pound? Well, Bank of England Governor Andrew Bailey is absolutely hyper-focused on public sector pay growth. He's watching like a hawk for any signs that it might start feeding into broader inflation. But that undershoot we saw in the April CPI data, that buys the BOE a lot of political breathing room to just hold steady at their upcoming June 18th meeting. And remember, the committee already voted 8-1 to hold at their last meeting. Chart-wise, GBP/USD presents as a sell-on rise, but honestly, it's just not a super convincing structure at the moment. You really need to keep a close watch on that 1.3474 resistance level, because if it breaks through there, it's going to quickly run up to test 1.3558. On the downside, your support levels are tiered out at 1.3450 and then 1.3393. Bringing it back home with Section 4 Nifty and Rupee Technicals. Here's the crucial takeaway for the domestic side. While the Nifty rebounded beautifully from its intraday low of 23,229.15, entirely thanks to that tech surge, the underlying market breadth is still highly cautious. We are watching a serious tug-of-war between the big institutions. FIIs are still net sellers, just offloading positions, while domestic institutional investors, the DIIs, are stepping up to provide that much-needed underlying support. But with those Middle East tensions hanging over everything, overall conviction is just running really low. So that quick buy-on-dips mood from yesterday? Yeah, because of the cautious breadth and the institutional selling, that has firmly flipped back to a sell-on-rise tactical view. For the Nifty 50, watch your resistance bands super closely between 23,576 and 23,699. If the market rolls over, your support zones are staggered downwards between 23,439 and 23,260.
Finally, let's look at the rupee. USD/INR is caught in a seriously tight squeeze right now. On one hand, you've got modest gains driven by incoming flows from the MSCI equity index rebalancing, but on the other hand, that's being completely wiped out by persistent corporate hedging demand. Plus, everyone is basically just sitting on their hands right now because the RBI Monetary Policy Committee is in session. Today is day 1 of 3. Governor Malhotra is going to give us the official word on Friday. While the market consensus strongly expects him to hold the repo rate at 5.25% for the third time in a row, nobody wants to get caught off guard here.
Locking in those technicals for the rupee, the structure for the pair remains a sell-on rise. If we do see a push upward, look to sell right into those specific resistance barriers overhead at 95.21 and 95.43. On the downside, your hard support levels to keep an eye on are 94.92 and 94.51. Which brings us to the big million-dollar macro question hanging over the markets today. We are seeing literally billions pouring into AI infrastructure, pushing equities to the moon, but at the exact same time, we've got oil flirting with $98. If those Middle East oil disruptions drag out and reignite global inflation fears, are central banks going to be backed into a corner? Will they be forced to keep rates painfully high and ultimately just crush this entire AI-driven equity optimism? Keep a really close eye on those technical levels we discussed today, guys, because they are going to be the absolute first to break if this narrative starts to shift. Thanks for hanging out for this explainer. Stay disciplined out there in the markets, and we'll catch you next time.